Hey traders, today we're diving into candle range theory, an advanced trading concept that can supercharge your win rates. By mastering CRT, you'll learn how to predict price movements and candle formations with precision, putting you in sync with institutional traders rather than being caught on the wrong side of their moves. In this video, we're going to cover some key concepts that will help you fully understand and master candle range theory. Here's what we'll dive into. What is candle range theory? The power of three. How accumulation, manipulation, and distribution work in the markets. How smart money uses the power of three to trap retail traders. How to predict smart money moves before they happen using CRT. Candle range theory pattern types. Time frame breakdown for CRT execution. Key times for high probability CRT setups. Practical examples of trading high probability CRT setups. So stick around. By the end of this video, you'll have a powerful tool in your trading arsenal. Candle range theory is built on a simple yet profound idea. Every candlestick on a chart reflects a range of price action. When viewed from a higher time frame, this candle represents the broader market's movements, and when zoomed into a lower time frame, you'll notice the micro movements forming within that range. Here's what you need to know. Every candle has a high and a low. These points form a price range. As you zoom into a lower time frame, this range becomes clearer and forms the basis of the CRT strategy. In markets, price moves through three main phases: accumulation, manipulation, and distribution, or what we call the power of three. These phases represent the cycle the market constantly moves through. Accumulation, this phase is where price consolidates and moves sideways, gathering liquidity. Manipulation, here, the market pushes price beyond key levels to trigger stop losses, grabbing liquidity. Distribution, after manipulation, price reverses and moves in the opposite direction to distribute liquidity. How smart money uses the three market phases to trap retail traders. Let's start with the accumulation phase. In this phase, smart money begins to build their positions while keeping the market relatively flat. You'll often see this as consolidation or sideways movement on the chart. The price stays contained within a defined range, and it looks like nothing major is happening. When we zoom out to the higher time frames, such as the daily or 4-hour chart, this accumulation phase often shows up as a narrow range candle or a series of small candles moving sideways. The purpose of this phase is simple. Smart money is preparing for the next stage, the manipulation phase. They are quietly accumulating long or short positions, all without triggering large price movements. Now, let's move on to the manipulation phase. This is where smart money grabs liquidity by triggering stop losses. They deliberately push the price below support or above resistance, causing retail traders to exit their positions or enter new ones, thinking the market is breaking out. When we observe this phase on higher time frames, such as the daily or 4-hour chart, we'll often notice long wicks or shadows extending below the candle's low in a bullish setup, or above the candle's high in a bearish setup. These wicks represent the market manipulation where smart money collects liquidity. This is where candle range theory, or CRT, becomes especially useful. CRT helps us spot this manipulation by observing these sharp movements on higher time frames. For example, if you see a long wick below a support level on the daily chart, it's a sign that the price was deliberately pushed down to trick traders into thinking a breakdown was happening. Once the liquidity grab is complete, the price usually reverses, marking the start of a bullish move. Now let's discuss the distribution phase. After the price has moved up or down following the manipulation phase, smart money starts offloading their positions. They do this while setting up another liquidity trap, this time at the resistance level in a bullish setup. Retail traders are often lured into buying at the top, thinking the price will continue rising, but instead, the price reverses sharply. On higher time frames, such as the daily or 4-hour chart, we typically see a long wick above resistance in a bullish trend. This wick indicates that smart money is offloading their positions while trapping traders again. The sharp reversal that follows confirms the distribution phase. Candle range theory, or CRT, helps us recognize this setup by focusing on price action near the high of the candle range. If the price wicks above the high and then reverses, it's a clear sign that smart money is distributing their positions. Let me give you a practical example to understand how you can predict smart money behavior before they even act. Look at this candle on the hourly time frame with a defined high and low. The price briefly drops below the low and forms a lower wick before closing back inside the range. This wick represents smart money's attempt to grab liquidity from stop losses placed below the support level. On a lower time frame, Like the 15-minute chart, this movement would appear as a sharp downward spike, triggering retail traders to sell. However, using CRT on the hourly chart, we can identify this as a liquidity grab. The quick reversal after the wick suggests that smart money is preparing to push the price higher. As a retail trader, when you switch to the lower time frame, such as the 15-minute chart in this trading scenario, you will find that the market has already made the liquidity grab and closed above the support level, presenting a trading opportunity. You would enter at the close of the bullish candle, with your stop loss placed 10 pips below the higher time frame's low. Your target can be set at the next higher time frame's resistance, which in this case is the hourly chart. Alright, now that we've walked through a practical example of how CRT plays out in real market conditions, let's shift gears and talk about CRT pattern types. Recognizing these patterns is key to spotting high probability setups and improving your trade entries. So let's break down the different types of CRT patterns you'll want to master. Let's start with the standard 3-candle CRT pattern. This is one of the most important setups you'll need to recognize when using candle range theory. First, you'll notice the first candle, which establishes the range by setting the high and low of the market for that time frame. Next comes the second candle. This is where smart money creates a manipulation move, usually by making a false breakout or breakdown to trap retail traders. Then, the third candle gives you the confirmation. It closes back inside or above the range, signaling the start of the reversal. Here's how you can use it. By identifying this pattern on a higher time frame, you can avoid getting caught in false breakouts. Instead, you'll position yourself to trade in the direction of the market after the manipulation phase has completed. Now, let's move on to the inside bar CRT pattern, another key setup you should be familiar with. Here's what happens. The inside bar forms when a candle stays completely within the range of the previous candle. This often indicates market indecision or consolidation. Smart money is waiting for the right moment to strike. Your job is to watch closely for price manipulation around this inside bar. When a false breakout happens, whether above or below the inside bar, that's your signal. Once the price reverses, it creates a perfect opportunity for you to jump into the trade and ride the sharp movement in the opposite direction. Now let's talk about the multi-candle range expansion pattern. This one is a bit different from the standard 3-candle setup because it involves more than 3 candles forming a larger range. You'll notice that with this pattern, the market takes its time to build up a range. That's what makes it so powerful. Now let's dive into one of the most important aspects of trading CRT. Time frame analysis. This is key to making your trades as precise as possible. Here's how it works. When you spot a CRT pattern on a higher time frame, you don't just stop there. You zoom in to a lower time frame to find your entry point and make sure your timing is spot on. For example, if you see a CRT setup on the daily time frame, your lower time frame for execution is the hourly chart. Why? Because the hourly will give you a clearer view of price action within that daily range, allowing you to place more accurate entries and exits. Now, if you spot a CRT on the 4-hour time frame, drop down to the 30-minute chart to refine your entry. The smaller time frames provide insight into price movements that aren't as obvious on the higher time frames. Some so-called gurus, who have never traded, recommend the 15-minute time frame as the lower time frame for the 4-hour chart. However, after testing 3,500 setups, we found that the best and most accurate lower time frame for the 4-hour chart is the 30-minute time frame. For a CRT on the hourly chart, you'd want to zoom into the 15-minute chart for more precise entries. Some traders recommend using the 5-minute chart, but in my experience, combining the hourly and 15-minute time frames provides great results. And finally, if you're analyzing the 15-minute chart, the 1-minute time frame is where you'll find those quick scalp opportunities. Let's take it up a notch. If you really want to take your trading to the next level, you need to understand that timing is just as crucial as spotting the setup itself. Because here's the truth, not all candle range setups are created equal, and one of the biggest factors that separates a winning trade from a losing one is when you catch it. So let's dive into the key times that can make or break your CRT trades. For Forex traders, here are the most important times to keep in mind: 1 a.m., 5 a.m., 9 a.m., 1 p.m., 5 p.m., and 9 p.m. These times are crucial because they align with key market sessions, like the London Open at 5 a.m. UTC and the New York Open at 1 p.m. UTC. These are periods when liquidity is at its highest and volatility spikes. This makes it the perfect time for spotting CRT setups, especially during session overlaps when two major markets are open at the same time. Let me give you an example. As you can see here, this is a candle range with a defined high and low on the hourly chart. This candle represents an accumulation, or a distribution phase, so we need to wait for the second candle to break below the low or above the high, and then close inside the range. Look at what happened next. The second candle breaks above the high, and if you check the time, you'll see that this candle, which purged the range, formed at 1 p.m. UTC. This time is crucial because it marks the opening of the New York session. During the London session, the market was trending upward following the accumulation phase, and at the start of the New York session, the market created a liquidity grab, signaling the beginning of the distribution phase. That's why the 1 p.m. time is so important when trading candle range theory. When looking at the time, don't switch to a lower time frame. I see this mistake made by many traders. You need to focus on the time of the purge on the higher time frame,